Hey, hello, everyone. I'm Devin Thorpe, and I'm really excited to be here with you today to sort of kick off this incredible, amazing discussion that we're going to have today. I'm really thrilled to be a small part of this. The Crowdfunding Professional Association, for those of you who are guests and new, we really appreciate you being here, but the CfPA is a membership organization for individuals and companies that are interested in crowdfunding, both from an investor standpoint and an entrepreneur issuer standpoint. We want to be and are a resource to people on both sides of that equation. And of course, for a lot of our resources, we draw on market participants like our great speakers that we'll be hearing from today, including Rebecca Kacaba, who's the CEO of Dealmaker, and Etan Butler, who's the CEO of the Dalmore Group. Membership in the CfPA is just $10 a month for an individual, and you can join at cfpa.org/join us. I really am excited about the conversation we're going to have today with Rebecca and Etan. We'll be talking about Reg A offerings, sort of the big brother of the crowdfunding space. We'll be talking about secondary private trading. This is kind of an exploding aspect of the marketplace. And then one of the things that really excites me the most about Regulation A is that there is a path to becoming a public company through that channel, allowing companies to get public at a smaller, earlier scale. And I'm a big believer in that. So I'm excited to talk to these two about these topics. It's going to be a great, important conversation. Brian Belley, first though. Brian is the vice president of KingsCrowd, one of the most thorough companies that's sort of following and tracking the crowdfunding and Reg A space, keeping track of essentially all the offerings. They probably have more data than anyone else. And Brian also serves as the CfPA treasurer. And one of those little known facts about Brian is that he has personally invested in over 200 Reg CF and Reg A deals. So he's an amazing human being. So Brian, welcome. Thank you for taking a few minutes to share some data with us.
Thank you for that kind introduction, Devin. Really excited to let Etan and Rebecca get to the good stuff. So I will try and keep this relatively brief. So I did want to just provide, let's take 8 minutes and provide a backdrop to give everyone a little bit of perspective as we go into the discussion around Regulation A. We'll talk a little bit about Reg CF and some of the data as well. But to set that backdrop, let's take a look at some quick data and trends in the regulated invested crowdfunding markets and see how that compares to some of the things that have been going on in both VC and through IPOs as well. So as Devin mentioned, and hopefully everyone can see my screen okay, head of product at KingsCrowd. So let's talk about some quick VC trends and public market trends, and we'll talk about some regulated investment crowdfunding trends with a focus on that Reg A space. Before we jump into it, I think this chart is an SEC chart that came from an annual report in 2022 that takes all these different exemptions that people can raise capital under and puts it onto scale on the same slide. So as you can see here, initial public offerings, 126 billion. This is for roughly fiscal year 2022, and 126 billion in IPOs. Pretty big. Now, when you take a look over here, 506B, these are traditional private placements, kind of angel accredited only deals, bigger than the public markets, $2.3 trillion, comparing that to what happened with IPOs in 22. When we start taking a look at some of the discussions we're going to be talking about today, Regulation A, 1.8 billion raised in 2022, and then also a little regulation crowdfunding down here, about 400 million. You can see that little dot there. So all these are just to say that, the private markets are huge, and there are these alternative pathways that allow issuers and entrepreneurs and companies to be able to raise capital compared to the traditional public route. And that's what we're going to be talking about. So some quick data on VC and just macro trends to kind of set this whole discussion up. When you look at global venture dollar volume, kind of 2013 to 2022, you can see that, as I think a lot of us are very familiar, in 2021 had a huge spike in global venture dollar volume and pulling back in 2022. Now, if you broke that down quarterly, what you'd see is that even Q1 and Q2 in 22 were pretty big, but really in Q3 and Q4, there was a lot of drawback in venture dollar volume. Now, this is also very similar to what we saw in the public markets. So if you take a look at US VC exit activity, again, huge exits, both in value and number of exits in 2021, followed by a huge pullback in 22. And when you look at IPOs, telling a similar story, right? Again, 1,000 IPOs, these are kind of all IPOs in 2021, down to 181, which is really kind of going back almost a decade in terms of the number of IPOs. And when you're looking at IPOs that are only 50 million market cap, telling the same story here. So there's a lot of these trends, right? And obviously, a lot of this is being driven by macroeconomic factors. But in addition, sorry, just one more slide. SPACs, again, different when we're talking about different pathways, direct listings, all following the similar trend, having kind of a big run up, during the COVID boom in 2020 and 21, and then having that pullback in 22. So when we look at regulated investment crowdfunding, both the Reg CF, Reg A space, how does that compare? One of the really interesting things is that the regulated investing online investing space really saw larger growth. So if we take a look at 2019 and 2020 compared to venture capital, as well as a smaller pullback. So when you take a look at 2021, and this data goes through roughly Q3 of 22, you can see that while they grew much more leading up to, it also shrank less, which I think is going to be kind of getting behind this theme that there are these alternative sources of raising capital and of investing for investors. And that's what we're going to be talking a lot about today. Kind of on a year-over-year basis, right, just breaking it down by the regulations, I think this is also pretty insightful, where, again, you can kind of see from the 2019 to 2020 timeframe versus 21 to 22, IPOs did have huge growth, which we saw in those charts, but we saw the same massive growth throughout a lot of the exemptions as well. So, Reg D 506B, which are those private placement offerings, up 54%. And we look at Reg A, up almost $800 million in just the year from kind of the 2020 to 22 timeframe. Same thing with Reg CF, huge growth, 517% growth over that timeframe. And obviously coming from a much smaller denominator starting, but overall showing this really overwhelming interest in these different alternative pathways of raising capital. I'm going to go through some of these other charts relatively quickly on the back end, and I will make sure that we post these so that everyone can have all of these for reference. But just some more kind of interesting comparisons looking at, in this case, Reg CF, but some of these regulated investment crowdfundings versus the public markets. This is total valuation. So you can think of it as S&P 500 market cap here in green, and Reg CF, regulation crowdfunding, total market cap, which is kind of the sum of all the valuations in purple here. So you can just see the quarter over quarter growth really exploding in terms of the amount of the growth in those private markets. And when you're looking at raise activity for both regulation crowdfunding and we'll also show in Regulation A, you'll notice a cyclical nature, at least to the Reg CF one, where again, a lot of the financial requirements kind of hit in the April and May timeframe of each year, which is why you see that dip. But overall, it's been growing, huge growth from the number of active Reg CF raises in the 100 in the 2018 timeframe to nearly 6x, right? Kind of looking at the peak, and actually still pretty strong from an issuer and entrepreneur perspective, even as late as the end of 2022. And we look at Regulation A activity, also seeing a lot of growth here. And, I'm sure we'll be talking about this as well, but this isn't even looking at all the secondary markets and the secondary trading and fractional issuers. This is really just looking at kind of those primary offerings by the startups themselves. So overall showing a huge opportunity here in terms of what this enables for those entrepreneurs and issuers, as well as the investors who are looking to invest. I'm going to go over some of these other slides pretty briefly. This is just more investment trends. So when you look at the amount of capital invested, obviously, this is Reg CF, and we're similar trends in Regulation A. A lot of invested capital, right, in the 2021 to 22 timeframe. And while it is pulling back, I think the underlying theme to remember here is that this is pulling back less than the public markets, less than venture capital, right? So while it started from a really small number, there's a lot of interest going into this area, both in Reg CF and Regulation A. And again, the axis here, Regulation A is raising much higher numbers than Reg CF. So while it looks like a small number here, we're still talking tens of millions of dollars. And I think this is an interesting chart as well. You know, when you're trying to take a look at the different alternative pathways, you know, just in terms of security types that are offered, right? You're still getting a lot of the equity and preferred, equity common and preferred on the Regulation A side, and seeing a bit more of, you know, some safes, convertible notes, and different types of investment vehicles on the regulation crowdfunding side. Valuation trends, you know, I think this is also some insightful data just showing, you know, what we saw. This is regulation crowdfunding, but seeing similar trends in the Reg A markets, you know, from roughly 2018 to the beginning of 23. And if you look at kind of 2018 to 23, similar upward trends, you know, roughly kind of 3x valuation trends in both the venture capital early stage markets, as well as these online alternative exemptions through Reg CF and Reg A. And then these slides, again, will be provided for reference. Not going to try to go over these in the few minutes we have remaining. But if you're interested in, like, as an issuer or someone looking to raise in a certain industry, what are the different revenue multiples? You know, we can break it down by all these different revenue multiples here, where you can see where you might stack up. As well as if you're looking at to bucket it in terms of revenue, I think it's really important. We're probably going to hear from Etan and Rebecca. There's all the different types of companies who can take advantage of this, from those pre-revenue companies, you know, or, you know, perhaps even raising smaller amounts based on smaller revenue, all the way up to companies that are making $10 million plus in ARR a year, right? So it's a really diverse kind of group of companies that raise using these exemptions, and really excited to hear more from both of our guests here today on that topic. So I'm going to hand it back over to Devin, and we will provide all these slides, and we can provide a link to the slides in the chat here as well. But thank you for your time today, and we'll talk to everyone soon.
Thanks, Brian. I really appreciate you taking the time to do that. I appreciate you sharing those slides, because I want to spend more time plowing through those, because there's some really interesting stuff in there. And I'm sure everyone wants to spend a little time trying to digest what you shared. I am excited to have the opportunity to visit with Rebecca and Etan today. Let me just take a minute each to introduce them. Rebecca is the CEO and co-founder of Dealmaker. She's winner of Lexpert's Top 40 Under 40, named one of North America's most innovative lawyers by the Financial Times. She's a finalist for 2022's Ernst & Young Entrepreneur of the Year and one of Canada's top 100 most powerful women. After a decade of practicing securities law, she took an ambitious leap from her partnership at the world's largest law firm and founded Dealmaker to build a system that would combat the costly inefficiencies that plague the traditional capital raise process. She is the force behind building Dealmaker into Canada's third fastest growing company, as ranked by the Globe and Mail's report on business. With her vision and drive, Rebecca has become a leader and a trailblazer in the intersection of capital markets and tech, who is committed to driving change and doing business the right way. In only 4 years, Dealmaker has powered over $1.7 billion in capital raised, and Rebecca currently serves as a board member for the CfPA. Etan Butler is the chairman of Dalmore Group, a FINRA-registered national broker-dealer investment bank founded in 2005. Dalmore provides a full range of investment banking services and assists companies seeking to raise capital from individual investors through the SEC's Regulation D, Regulation A+, and Regulation CF. Dalmore is among the most active broker-dealers in the world for Regulation A+ offerings, having onboarded more than 250 such offerings, including some of the most successful Reg A+ offerings in history. Etan was awarded the Industry Leader of the Year in 2022 at the Equity Crowdfunding Awards. Dalmore Group was awarded Self-Hosted BD of the Year and Self-Hosted Technology of the Year. Etan currently serves as a board member for the CfPA too. We're thrilled to have Etan and Rebecca on the board, and I'm thrilled to have a chance to visit with them today. Rebecca, let me toss the first question in your direction, if I may. Some people have described Reg A Plus as a mini IPO type offering. Why is that?
Thanks, Devin. Thanks for having me. Great to be here. I think to us, Reg A is such an exciting opportunity because it allows you to raise a significant amount of capital, up to $75 million, and test the waters of public interest by doing that without going full bore with a traditional IPO, right? Traditional IPO costs a lot of money. You need a a lot of bankers, you need a lot of revenue. Reg A is giving that opportunity to get retail investors into the story, raise big amounts of money with the filing of the 1A with the SEC, and going through just a shorter process than you would for a fulsome IPO. So it's really, Congress saw an opportunity to let the average American invest in pre-IPO deals because they saw that companies were staying private longer, and they saw that the public should have the ability to get in on these stories and get the gains. And Reg A is the way that the average American can do that.
Yeah. But not all Reg A plus offerings yield a public company, right? There's a choice still there, right?
Mm-hmm.
Etan, let me turn to you now. Dalmore has onboarded over 250 Reg A plus offerings to date and has completed over 1 million Reg A plus investments and over 150,000 secondary trades. Where are you seeing the secondary trading from? Where's that going on?
We're seeing, well, there's something in Reg A called a series offering. And that is a company that gets qualified to raise the same 75 million, but doesn't approach it as a one and done capital raise where they're issuing shares out of one entity, equity or debt. Rather, as a series entity, they're able to IPO an ongoing number of individual assets or investment opportunities, in essence, drawing down collectively from that 75 million. And what that does is it allows for them to offer their base of investors the opportunity to build a portfolio of different investments, right? And oftentimes in very small share size increments. And where we're seeing the most activity in this fractional share series approach is in the real estate industry. We have a couple issuers that are selling single family homes. We're seeing it in the collectible space. We're seeing it in the racehorse and in the music fractionalization space. And again, it gives investors the ability to build portfolios. It's not, I want to buy into this fund or I want to invest in this company per se. It's that this company, this is offering me the opportunity to build a fractional portfolio. And when I'm buying a $10 share of a Michael Jordan rookie, I want to see the bid and ask right next to it. And it's perhaps in a different way than when I make a $2,000 or $3,000 investment in what I hope might go public one day. So we're seeing a lot of secondary trading amongst these fractional share platforms.
Interesting. That's fascinating. Just a glimpse into a world I haven't played in. Rebecca, what types of companies are using Reg A plus? Are you saying, is it startups or is it more mature companies that have or is it publicly traded companies, real estate? What are you seeing?
We see the whole gamut of the life cycle. So typically you'll see an earlier stage company doing a Reg CF and then a little bit more mature company doing a Reg A. We get lots of public companies doing these as well. Sometimes you have a more mature company that says, look, I only need to raise 5 mil and it's quicker and cheaper to get a Reg CF set up. So we're just going to do that right now. We have a company that's done the whole life cycle of equity crowdfunding now going public. And they did a Reg CF immediately prior to their going public. Now they're doing the going public paired with a Reg A. So lots of different ways to use these exemptions. Lots of different types of companies using them totally across the gamut as well. I took a look, before this at our stats over the last year of the type of companies that we see across the Dealmaker platform. So number 1, tech and robotics companies. Number 2 was real estate and construction companies. Those are the second biggest users of the exemptions. Third was a tie among life sciences, health tech, and mining companies. And then down the list, you got into all the other categories: manufacturing, fintech, retail, gaming, clean tech, SPACs and CPCs doing their different exemptions. So all different types of companies that we see, usually companies that have a brand that's going to speak to the average American who's going to want to make an investment, like the Michael Jordan shoes. Everyone knows what that is. Easy to grab that and want to own a piece of that.
Excellent. It's just really a fascinating space. And Etan, I want to turn to you now. It seems like as we were talking about the secondary trading, that's really a positive for the investors. It's pretty clear that if you have a mechanism for getting some liquidity, that's just an unadulterated good. Why doesn't every Reg D, Reg A plus, and Reg CF issuer facilitate secondary trading of their securities? Are there downsides to the issuers?
So first, there's a difference amongst the exemptions and what they afford investors with the ability to access and be able to trade their shares on the secondary. Regulation CF and Regulation D have a 1-year lockup period on the securities. So you have to wait a year before you trade them. Whereas Regulation A, there's an immediate path to potential liquidity. Doesn't mean there's going to be liquidity, and don't assume there will be. It's still very early days. And so I think we're going to see a continued significant increase in secondary trading, especially in the Reg A space. And as some of these Reg D and Reg CFs mature and are in a position to be on the secondary. Downsides, right? So first, the issuer of the securities has to help, oftentimes will have to help facilitate secondary trading, which means they're going to have to pay an alternative trading system, a listing fee to list their securities on that alternative trading system, which in essence is a matching engine that allows for the bid and ask to be present, right, for investors to participate in. So they have to want to make that investment, right? So it has to be kind of part of their strategy. If they have a limited number of investors, and it's really not, they're not really worried about secondary, they're really worried about this is a one and done opportunity to get me to where I need to get to. They might not, they may not go through the burden or the expense in doing that, right? Oftentimes there's technological integrations to in order to facilitate that. Another potential downside might be if an issuer, let's use that Michael Jordan rookie example, $10 shares. I buy a $10 share and then I go back on the platform and I want to look at the secondary and I see a bid of $8 the next day. I feel like I'm down $2. Doesn't mean I am, but it means that because if there's not enough liquidity, not enough investors who are on the bid, who are on that platform, who are looking at these assets, like they might look at the NASDAQ or the New York Stock Exchange, because it's so early days, then I'm gonna have the impression that I'm losing money right from the beginning because there's not enough people on the bid. So that could be a potential thing to kind of look into. So you want to make sure there's enough eyeballs on your market, on your assets, sure, to really justify that. But again, it is early days. I think we're going to see a lot more movement, a lot more secondary, especially in the real estate industry, in the art industry, in the music royalties industries. These are billion-trillion-dollar industries where the private markets are bigger than the public markets. And I think we're going to move closer and closer towards a similar-ish type of experience for investors and for issuers who look in the paper in the morning and they see the bid and ask with greater audiences and more institutional participation in the private markets. I think secondary will continue to grow.
Yeah, it's exciting to think about what this means. So thank you. Now, Rebecca, back to you. Is Reg A Plus a better alternative to venture capital? And if so, why? What are the risks that offset some of the advantages of Reg A Plus over venture capital?
Yeah, it's a great question. I don't really think of it, Devin, as like an either or. I think they can be very complementary. You've got Wall Street, broker going publics. I think that's a very complementary part of the ecosystem as well. It has different benefits, right? And those are emerging the longer all of us have been building this ecosystem and seeing the benefits of the story. So building a community of support around a company, maybe it's beta testers and users, maybe it's people that can provide contracts to that company that then lead to its growth. I myself have raised capital a couple of times, and I've really used my investor base that way as well, as a community of supporters that help you build the company. And so I think, we're all trying to help founders understand that as they have a mailing list, that can be a community of supporter in other ways than just maybe someone who receives their email and tries their product. They could make them an investor as well. So the community building aspect of it is emerging as really one of the strong benefits. Keeping control of the business and owning more of it is part of the equation as well, right? Because you're not negotiating against the table from someone who's telling you what your valuation is, what the structure of the preferred shares you're going to issue is. You're deciding that and taking that to market and marketing around yourself. And so that can be very attractive to founders when they consider the different ways they raise capital. But really, ultimately, we have seen it filling a gap in the funding world that might exist for different types of companies that VC or private equity or Wall Street is not as interested in. Valuable business model. Maybe it's a bit more transactional than what those kinds of investors are looking for. Maybe it's a different industry with a different total addressable market that can still get a lot of growth and good viable. But for those kind of professional investors, the 10x returns aren't there. But that's more than enough for the equity crowdfunding world. And so we're seeing different types of businesses get funded. We're seeing different types of founders get funded, right? Minority groups getting funded now to the tune of about 35% versus 2% in the VC world. So different types of folks getting great access to funding that wouldn't have otherwise had access. So we're really seeing this as an emerging category. And I think, Brian did a great job of outlining where the benefits are, because there's been so much drive and growth of folks understanding what equity crowdfunding can do for them, and more deals. We had more deals launched this year than we did last year in the space. More founders understanding the benefits to them.
Fantastic. This is just so exciting. I love thinking about this and thinking about crowdfunding in all its forms as a complement to venture capital is exciting too. Etan, of course, as we think about investing and the liquidity we've been talking about through the secondary markets, I want to drill down on something we kind of started talking about, and that is the cost to the issuer and the investors of trading those secondary shares in the private market. And I would just add, are ordinary, we often call them retail investors, eligible to buy in those secondary markets, or is it always limited to the accredited investors? If it's a Reg CF deal or a Reg A plus deal that ordinary investors can invest in, is it eligible for? So there's a lot to cover there. But looking at those costs and then looking at the regulations around that, Etan, give us the picture.
Generally, when shares become freely tradable, anyone can participate in them, provided that they have gone through a certain level of diligence, like KYC, know your customer, anti-money laundering, OFAC checks, jurisdiction checks, et cetera. So generally there's going to be a broker dealer that's going to have responsibility to kind of clear those investors from a suitability perspective. And once they are cleared, both retail and both not accredited and not yet accredited investors could access and participate in those secondary trades. As far as cost, so it really depends on the alternative trading system that an issuer is talking with. And again, it's very early days, and there's a big variance amongst cost structures that we've seen. Generally speaking, there at least is going to be an annual listing fee, right, to list the securities on an annual basis on an alternative trading system. And then there will be a commission, right? In a similar way on the primary, there's going to be a commission that, generally speaking, the investors, right, the buyer and seller would pay a commission. Currently, The structures are as low as $10,000 per year for a listing fee to list the securities on an alternative trading system, and as low as in the range of 1% commission to the buyer and 1% commission to the seller. That's kind of like the average of what's going on right now in the secondary. And then it goes up from there, right? So I think you see, traditionally most of the secondary, that I've seen has happened with pre-IPO companies. These are kind of big brand names that we all know that are not yet public. They're pre-IPO, and everyone's waiting for the IPO, and everyone can relate to it. Maybe they're unicorns, and maybe some of the founders and want to take some of the chips off the table. De-risk themselves, hedge themselves a bit going into an IPO. And there's a lot of retail interest and awareness of these companies, more so than there might be a private company that's listing assets on an alternative trading system. And so the cost structure that I've seen for some of those, to participate in some of those, bigger brand name pre-IPO companies has tended to be higher. Has tended to be more like in the 4 or 5% range. So it's interesting, but I think costs are going down. I think more private companies are exploring a path to potential liquidity, and it makes total sense, right? I mean, why should assets have to be trapped when there really is, when they don't have to be, and when there's an appetite for others to bid and ask on them? So that's what we're seeing.
Now, that's fascinating, Etan, and it is interesting to think about how the areas where there's more demand, the fees are going up. It'll be interesting to see if those fees get squeezed out. Rebecca, I want to turn to you now. It seems to me that with a successful Reg A Plus offering, it's not that hard for an issuer that could raise $50 million, give or take. They would almost by definition qualify for NASDAQ listing by all the requirements. And so there is a path, right, for a company to go through a Reg A offering and end up listed on the exchange. Isn't there a way that can be navigated?
Yeah, absolutely. And we will also see Reg A's done by companies once they're already listed. Companies like Dragonfly did, a Reg A while they were on the OTC. During promotion of the offering, the share price went from, up all the way up to $3.19, and then they uplisted on the NASDAQ. Companies like Trustamp, I think Etan and I worked on that one together. They did a $5 million Reg CF while they were on the OTC, uplisted to NASDAQ after that. Again, share price jumped while they were marketing the offering. So there's definitely a path for companies to do the Reg CFs to the Reg A to the go public. There's also, like I said, we have one company doing Reg A simultaneously with going public. And then there's public companies using the Reg A exemption really successfully, understanding what they're doing and how to market it differently than the publicly tradable stock. That has worked really well. And because of all the associated promotion and awareness about the stock, it's had a positive impact on the stock price. So lots of exciting things happening in the space.
Yeah. Etan, I want to turn to you with Peter Rostovsky in our audience, who's also on our board, had a great question. We think of crowdfunding and Reg A stuff as individual players. And yet one of the things that eventually has to happen for us to really scale these offerings is to have institutional players participating in these markets. What are you seeing? Maybe, Etan, you could respond, and then we could get Rebecca's take on this as well. Are we seeing institutions, maybe folks who are traditionally limited partners in venture funds, beginning to invest directly in companies?
Yes, we are. Keep in mind that 2019 was the first year that over $1 billion was raised in Reg A, so it's still a baby relative to Reg D. Yes, that has gone up significantly, and it makes sense because it's a fascinating exemption that allows a company to promote their offering and raise capital from pretty much anyone over the age of 18 in many jurisdictions. And the shares are freely tradable. So yes, you have to go through SEC qualification, and yes, you have to hire an attorney, and there's an expense in it and get an audit, but the result is $75 a year. So I think that what's the ultimate play here, I believe, as far as opening it up to institutional investors, is there is a real thirst amongst managed accounts and institutional accounts, investors, to access private alternative investments currently that are not correlated to the markets, like private REITs, yield generating, and instruments, as well as even things like collectibles, et cetera. But it's going to take a sizable enough collection of these assets to justify real diligence and real interest amongst some of the institutional players. Where I think this is going, and I think it's going to happen first with real estate, art, and perhaps music royalties, and some others, with these really big, lumpy asset sizes, are things like DTC eligibility for some of these securities. That's going to make it more efficient and easier for someone, let's say, that has a Charles Schwab account, to allocate towards some of these private alternative investments in a similar way that they are other types of investments. So I think the RIA world, right, that with much, if I'm an investment advisor and I'm getting paid 1% for assets under management per year, I don't want my investors to go and take hundreds of thousands or millions of dollars on their own to go to these other platforms. I want to have an efficient way to help allocate their funds in a format that I could digest and keep those assets on my platform so I can make fees on it. I think that's really where the real opportunity is here. So I think we're going to see a consolidation. It's not just going to be utilizing Reg A to build your own community, which is very valuable in itself, but it's going to be positioning it so that it is adaptable and digestible for some of the institutional investor communities. And I think that's where we're going to see big changes on, throughout the rest of this year.
Yeah, fascinating. Rebecca, what are you seeing with institutions over at Dealmaker?
Yeah, we've seen issuers take institutional investment into the Reg A alongside retail. We've seen different players in different parts of the capital market ecosystem realize the benefits of a community round and use that as a component of the fundraising strategy for an issuer. And I think we'll see that more and more. Someone asked me a while back, like, what does it take for a company to use equity crowdfunding their whole life cycle, because that's what is needed for the equity crowdfunding sector to grow. And I said, well, I disagree entirely. The capital markets operate as one whole ecosystem, right? You have venture-backed companies that then eventually will IPO with Wall Street bankers. Those pieces of the market work symbiotically. And what we're seeing is equity crowdfunding emerging, staying strong through a down market, and folks in the other pieces of the market recognizing the benefits of it and the benefits of the community. And the same way they might recognize the benefits of trading secondary on one of the ATSs that Etan is talking about before they do a full go public on a NASDAQ. So there's so many different paths that an issuer can choose to get capitalized and then provide liquidity to their shareholders. What's important to me is the stats that Brian shared, showing that the space and the pillar of the capital markets that is equity crowdfunding is emerging and it's staying stronger, and other players recognizing that and seeing the benefits of the issuers that Etan and I work with, and seeing how those issuers come to market, they become successful, and this becomes a growth sector.
Yeah. Thank you. This is all exciting to me, and I think the growing participation of institutions has the potential to really be a huge addition, a benefit to this whole industry space. Jonathan Cohen, though, who's one of our participants today, said he's got a company that was very successful, raised over $10 million under Reg A plus. and then tried to facilitate secondary trading on Start Engine with their ATS. And he describes it as a total flop, zero trading. So he's wondering, what are we smoking? No, he didn't ask that. He said, why are you so optimistic about secondary trading for equity crowdfunding? Maybe, Etan, we could start with you and then give Rebecca a chance to add her voice to that.
I think it's early days, and I think it comes down to common sense, right? If I'm in the business of making investments in private companies, you know, and there's no secondary, there's no path to secondary, then that money is trapped until the founder decides to do whatever might be next, and I'm kind of dragged along with that outcome. However, if I have a path to potential, I might not be able to, you know, find someone that's going to pay me the same amount as I put my, you know, that I invested in. But anything is better than nothing. It's another option. And I think it's going to get more mature. I think they're ultimately going to be proprietary traders, arbitrage opportunities, market makers, right? So all that is what's to come. You know, Start Engine was very early on in building a secondary market. I think it was a very smart move for them to do, and I'm not surprised that those who are amongst the first to access that, you know, hey, wait a minute, when I open up the NASDAQ and I'm looking at my portfolio, there's a tight bid and ask, and there's liquidity there, but here there's no one. It's crickets. It's new technology. It's a new process. There's a limited number of people looking at it right now. It's evolving, and it's to be expected. It's going to take a while, and it's very important that issuers and investors have their eyes open and recognize that this isn't going to bring liquidity at all. It's not going to bring interest. It's going to bring awareness. It's going to bring an opportunity, and that opportunity is going to become more valuable, I think, over time.
Yeah, Rebecca, what would you add to that?
I agree with all that, Devin, and I also think, like, what's cool about ATS is, you know, the ability to limit trading hours and the ability to limit caps on creeps on size of position. And so I think there's a number of tools associated with ATSs that are very unique and different from a public market, and those tools will be explored, and the benefits of that will evolve and develop over time. So I agree with Etan, you know, it's in early days. So to expect the liquidity that you're going to see on the stock exchanges that have been around, you know, for ages and ages and have developed that marketplace, you're not going to see that right on day one. But there are some different tools, and creating that tension that they successfully did in their round is really the key to all of this. So, you know, are there going to be enough traders who want to trade 24/7? No, but is there opening a bid once a month and that getting people the liquidity they need, given the amount of bids and asks there are? I don't know. Maybe I just throw it out there.
Yeah, I've got a follow-up question. You know, I think one of the things that is so difficult, and as a former investment banker myself, I'm a firm believer that there's more art than science in valuation. Do you think that the existence of secondary trading will have I'll call it a reconciling effect, but I'm frankly thinking, is that going to pull valuations of offerings on the platforms down a little bit? Now, I'm sure your offerings on Dalmore Group and Dealmaker, they're always perfectly valued, but on some of the other platforms, there may be offerings that are overvalued. Is that existence of secondary trading going to pull those valuations closer to Earth orbit?
I think you've got a headwind and a tailwind, because it could do that, but you also typically see a bump in valuation when there's more immediate liquidity. And so depending on how an offering is priced, how do those two things reconcile is the question.
Yeah. Etan, do you want to add anything to that?
I think platforms like KingsCrowd are gonna bring more transparency into the market, and more analysis, and better tools for investors to understand valuation and see how that valuation compares with other companies that are, I guess, somewhat similar, is going to be healthy. overall for the private markets and for valuation. That said, it is not necessarily an easy thing to do to put a value on a startup. And they're all very different. They all have different levels of IP and addressable markets and backgrounds of their founders. So it's like it's how do you put a valuation on a startup? You look at comps. You could hire a company to give you a valuation if you want, but I think that again, I think like platforms like KingsCrowd are going to be really helpful from an investor's perspective to go and see what's out there and how this compares to other things. And it's better visibility than just looking at an offering circular. When you're able to kind of see how it stacks up against other things in a similar industry.
Yeah,
I don't think secondary per se has to affect is necessarily going to affect valuation.
Interesting. Good thinking. Well, I appreciate that. Brian Christie, also a member of the board, had a great question. Once you have a listing on an ATS, can an issuer have some control over the trading? For instance, and Rebecca, maybe you hinted at this, can you control when the trades happen, say to limit it to 1 week per month or even a day?
That's my understanding. Etan might know better from some of the ones I've talked to.
Yeah, you can. You could structure it kind of how you want. It could be a one day a week trading window. It could be full time. It could be during market hours. Again, it depends on the technology functionality of the ATS and the broker dealer that operates the ATS and what their infrastructure is like and what they have available. Again, very early days, but you certainly could have you could determine the trading windows and the different features and functionalities of the secondary trading market that you make available for your community, for sure.
Yeah. Well,
and another functionality that I think is really cool that I touched on, because I always think about things from the founder's perspective, right, is like on a stock market, you get people doing creeping bids and hostile takeovers. On an ATS, you can limit that, which is really, really cool to me, because you can make sure that someone doesn't hostile take over your company, but you're still providing liquidity. So those kinds of controls, very, very interesting.
Yeah. On ATSs, are there any short trades allowed on any of those platforms yet, or is that prohibited by the design of those platforms?
I haven't seen any short trading. In fact, I've heard from a few ATSs that they're not going to facilitate the ability to short trade. I don't know if it's possible. I imagine it might be if it's set up, if it's structured that way, but we haven't yet seen that. We haven't really seen market makers either, but it's going to develop, and as these things develop, I think it's going to look more and more like the public markets in certain ways. That's going to be really interesting.
Yeah, fascinating. Well, Etan, as we approach the end of our discussion today, where do you think we will see the biggest growth this year in terms of secondary trading of private securities?
I think kind of like I touched on before, there two areas. One is with a lot of these brand name unicorns last year that might not be, they may just be ponies this year based on valuation. I think we're going to see. I think it's going to bring a lot of volatility and opportunity in the value of some of these shares pre-IPO. So I think we're going to see, and that's been going on for a number of years. That element of the secondary trading for those Reg D pre-IPO companies. I think we'll see an uptick in that for sure. And then again, I think this is going to be the year when we bridge the gap between the production of private alternative investments, right, and that's in collectibles, real estate, royalties, et cetera, and institutional and managed accounts and capital in the RIA world. I think that, and that's going to be clarified through technology and different types of structures. So I think that's where we're going to see, I think, the biggest growth in secondary. And a rise in more sophisticated issuers that take advantage of those pipes DTC eligibility, again, once it's on brokerage statements, once there's a custodian involved, it's a different game. It's not, let me just market on Facebook and TikTok and articles and PR. It's let's get institutional, which is where the significant capital really is, and really have a greater audience to participate in the production of these alternative assets and investments.
Yeah. Well, it is fascinating to think about where we're going, where we're heading. Exciting to think about that. So thank you, Rebecca. I see in this crowdfunding space all kinds of companies. We see a lot of little distilleries, restaurants, cafes. Some of them end up with hundreds of shareholders. And in some ways, they've got to be thinking about liquidity for those folks, even though they don't want to sell the business. And an IPO may be tempting, some sort of public offering. And of course, on the other hand, there are lots of great companies that you deal with all the time, you and Etan, with companies that are doing, $3, $4, $5 million Reg CF rounds, and then they do big Reg A rounds, 10, 20. When does it make sense for a company that did a crowdfunding round to really be serious about trying to go public?
I think it depends on the company. So I typically say, like, a revenue generating company, you're going to have a threshold of revenues where you can sustain, like, the department and the infrastructure and the thought that it's the legal fees and the audit fees and the thought that it's going to take to be full-fledged public. And so what is that revenue threshold? Some people will call it anywhere from 30 to 50 million. You've got other kinds of companies that need the access to the public markets, like mining or oil and gas or high tech, where that liquidity is interesting to people to write bigger checks. And so they're going public and building that infrastructure for a different reason. So I think that you've got to take a look at the company and what makes sense for them. But I think that's why ATSs present a really nice alternative for folks pre-going public who don't want to build that whole infrastructure the same way Reg A is that nice alternative before you do a full-fledged IPO.
Yeah. Well, Rebecca, Etan, I want to thank both of you for the time you spent with us today. It's really an honor to be able to tap into your collective wisdom. You guys really see from your vantage point things that the rest of us just cannot see. And so we appreciate you sharing some of your insights and your wisdom with us today. We really appreciate it. We'll be sharing this. I want everyone in the audience to know we'll share this so that you can go back and rewatch it to better understand what Etan and Rebecca have been sharing with us. And of course, Brian shared the link to his slides. We'll make those available as well. But thank you all for being with us. We are grateful that you would take the time out of your busy schedule to participate in the discussion today. And we look forward to seeing you next month. We plan to do this each and every month going forward. And so our next session will be on the second Wednesday of April, which will be the 12th of April, I believe. So watch for the next event on April 12th. Thanks, everybody. Take care now.